Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is Thursday, March 5th. I'm recording this from New York City, and I'm delighted to be joined here today by Ryan Boothroyd, who is Head of External Manager Research at Borders to Coast. Welcome, Ryan. Great to see you here.
Hey, Ethan, thanks.
Well, let me bring up the slides. You're very definitely reaching the spring weather. It's been much overdue and very welcome. Although there has been a lot of troubling geopolitical developments just in the last week. And for that reason, many of our comments here may focus on that more than usual. As usual, we will discuss inflation, interest rates, although less so this week. Geopolitics will be at the fore. We'll discuss equity markets and touch on other asset classes, primarily discussing how they have been affected by the dramatic geopolitical developments. And we'll ask whether they are behaving like traditional safety trades or whether we need to rethink those assets that will represent traditional safety trades. In terms of some of the sub-themes today, we are going to look at inflation, which seems to be rearing its head yet again. We'll ask if that is a phony explosion of inflation or whether there is something more sinister afoot. We're going to look at the caution that has been for some time building within equity markets for various reasons and look at how that has reacted to the dramatic geopolitical events. In light of that, we're going to ask where the safety trade could be at this time, if there is any, or whether the global contagion seems to be more the norm. Speaking of that, looking at emerging markets, how they have reacted to the geopolitical events, and then returning to some of the themes that have still been persistent despite the geopolitical developments. We're going to look at AI, some of the binary outcomes that are being discussed and the uncertainty that surrounds them, as well as private credit, both enmeshed in the AI story and as a standalone area of concern for some investors. As I mentioned, this is Ryan. He's head of external management at Border to Coast, over 100 billion in assets under management, represents the assets of 18 UK local government pension funds. Welcome again, Ryan. Great to see you here. A little bit about the long-term investment orientation the pensions fund might have. We are speaking about these macro factors with a view to how they might affect a portfolio and its allocation. So obviously inflation, clearly a risk factor, always top of mind for pension funds. Up to now, we seem to look like that inflation was coming into check. We had very convincing low inflation numbers below 2% in Europe. We did have in the US numbers approaching 3%. Just last week, we showed a chart showing that service inflation was starting to contract and that labor was starting to be less of a factor. And then in the UK, we even had positive news as inflation was heading to 3%. Just in the last week or so, we've had news coming out of the UK around food inflation being up closer to over 4%. And we also know that the number in Europe was closer to 1.9% versus 1.7% as expected. And now that we have oil being driven higher again, there is a concern that this is going to be putting pressure on inflation. And again, looking at the ISM index, prices there seem to be rising the fastest since 2022. So I suppose the question is this, as the headline here at the beginning states, a phony scare because it's driven by oil prices primarily? Or were we too confident in suggesting that inflation had been under control? How are you thinking about inflation these days?
Yeah, I think we need to have a bit of humility in the short term. It's very difficult to know exactly what impact the current crisis might have on short-term inflation, particularly in countries that are a lot more exposed to energy prices, so kind of material energy importers. But I think your comments at the start are still true. So the underlying background here is still positive. I think we're still broadly moving towards target in most cases. We've got labour market slack or emerging labour market slack for the first time in a while. Goods disinflation as well. So I think the general theme prior to this week was of kind of a positive move back towards something that feels like more normal. But in the short term, it's very difficult to know how that might change. But I think if we take a bigger step back, what we probably have moved into, when I think about the current environment, the next 10 years, for example, versus the last 10 years, we've clearly got an environment of more inflation volatility. So even if, even if this crisis subsides and we get back to something that feels more normal, we're still in an environment where the potential for exogenous inflation shocks is probably higher than it's been for some time. And so I think if you're a longer term investor, particularly a longer term investor who, like myself, a large part of your career was, inflation was not even talked about. It was a total sideshow. I think we need to make sure that there is kind of portfolio resilience to that unexpected inflation shock, and that when we're thinking about asset prices, things like longer dated bonds, for example, we're getting enough compensation for that additional inflation volatility kind of medium term.
Yeah, that's a great point. And if there is that volatility, yes, around inflation expectations, that is going to create more uncertainty for the consumer. I'm sure more wariness about making large purchases or large commitments. And it also muddies the interest rate outlook somewhat, as I've seen certainly interest rate expectations move around significantly, even over the course of this week, as some of the inflation numbers have moved around. The expectations of the number of cuts has come in, it seems, when it looks like inflation may not have been subsiding. And we haven't discussed interest rates, particularly this week. There hasn't been much to discuss in that for, given some of the other news flow. But I suppose if we were to take this then into an economy vibe check, and this gets to some of the caution that had been building, one thing I noticed is that we have seen a preponderance of headlines around job cuts recently, most of that stemming from AI. Well, we have seen not only Block announce 40% of its headcount cut, as another announcement yesterday, Morgan Stanley cutting 2,500 jobs despite its core business doing well. So these may be those kind of preemptive cuts. We've talked in the past about a low hiring, low firing equilibrium, when it seems to me that there is not actually a low hiring. There seems to be relatively no hiring, and there is firing. So I think maybe we need to rethink that that sense that we are in balance in that way. And equally, the consumer does seem to be showing signs of certainly concern and attrition. When if you were to kind of take a look at the economy, a snapshot, how are you thinking about the general economic health at this point?
Yeah, I think the comments on the labour market are very valid. I think compositionally is probably the most interesting aspect of the labour market. There's certain sectors where you're clearly seeing huge amounts of pressure. But I think a good vibe check, particularly if you think about the US, for example, would be something like American Express, which is a kind of classic, bellwether for the kind of white collar consumer, if you like. And you've seen that's been very strong for a long period of time, and that kind of underscores, I think, the fact that we've had a pretty strong, healthy kind of middle class consumer for quite some time, even if the broader perspective has been a little bit more complicated. So you're probably tired of hearing about the idea of the K-shaped economy. The kind of the upper part of the K has historically been, particularly over the last year or so, that kind of higher paid middle class worker, whereas the rest of the economy has been a little bit more questionable. I think what we're starting to get into at the moment, and I'm probably preempting a conversation about AI later, is whether or not you start to see broader weakness. Because when you cite some of those job cuts, places like Morgan Stanley, for example, that's a slightly different composition of softness, and that those types of consumers have a much higher propensity to spend. When you're thinking about consumer spending going forwards, that is the area where you get relatively small numbers of job cuts can have a kind of magnified impact on the potential economy going forwards. But just to zoom out a little bit, generally this time around, the consumer is in pretty good health. Consumer balance sheets are pretty good. We're not in a situation like we've been in historic slowdowns, if you like, where you've seen real kind of consumer fragility. And so I think that's a real positive. I think what we're probably have been dependent on from an economic perspective over the past 4 or 5 years, particularly in the US, has been continued fiscal expansion. And I think what we're seeing there is a kind of that it's difficult to paint a path for significant fiscal expansion in most developed countries now, given constraints around debt levels and such. And so if that lever goes, if the consumer starts to soften a little bit, then we're left kind of with the investment side. And again, we've had a huge positive tailwind there from AI capex spending. That's really kind of keeping things motoring along at the aggregate level at the moment. So if that starts to weaken, then there's a little bit there's less. We've got fewer kind of big tailwinds, if you like. So I think generally, given how long this kind of economic expansion has been going on for, even absent COVID, we're in a reasonable place. But yeah, I think you're right. I think there's a little bit more fragility in some of those kind of core legs, if you like, that have been holding up the kind of global economy for the last 3 or 4 years. Are starting to see a little bit more fragility.
Yeah, that's a great point. And just to look at this chart, we have had caution building in the background for some time now, actually the last 6 months, underperformance of the S&P. S&P relative to gold performing quite poorly. Gold clearly remaining at the fore despite some volatility at the beginning of the year. And we've definitely shown charts in the past showing how that because of that K-shaped economy, that lower end consumer really is not moving the needle when it comes to expenditure. But it seems that this kind of caution has been creeping in, certainly across the board. I did Bloomberg yesterday and I spoke about the concept of shock absorbers because they spoke about the geopolitical shock. And I think it's safe to say that up to recently, geopolitics did not really create that many shockwaves throughout markets. They seemed somewhat resilient. But because there was the shock absorber seemed to be that strength of AI, the strength of the tech story, which really did shore up the US economy. So if the edifice are starting to show, the cracks in that edifice are starting to show, I think that's where, if we don't have that as a shock absorber, perhaps that's what was in mind of investors as things did start to sell off over the course of this week. So obviously we don't need to restate what the geopolitical news has been. We're still very much in the throes of early days of the kinetic action in Iran. This is the sell-off that has been taking shape so far. This was only 2 days into the trading week. We saw selling intensifying by the stock markets, particularly in emerging markets. We saw gold sell off, interestingly, as maybe think about as a safety trade. We saw oil rise dramatically, and we had seen oil definitely very sensitive to rumors coming out of that region, and the dollar strengthen. So I suppose you and your thinking of your asset allocation approach, when you see, is this sort of in the scheme of what you would be expecting as a scenario analysis as you think about the geopolitical news? Is this how you would have expected some of these asset classes to react?
I mean, I think the market reaction generally has been pretty orderly. You know, if you'd painted this picture 5 or 10 years ago and asked what happened to oil prices, I think a sort of mid-high single-digit rally would have seemed pretty modest compared to what the expectations might have been. I think the most interesting thing for me looking at the current market moves is a lot of this is being accentuated by extended positioning and sentiment. And I think that's why you've seen particularly strange moves in some areas. So you take gold, for example. Gold has been on a tear. We all know this for the past year, 18 months. It's been extremely strong. People are probably over positioned in most cases. In the same way, when you look at somewhere like South Korea, that market's up 150% over the past year. Why has that created the most of all global equity markets over the past few days? Yes, South Korea is a net energy importer, so it's going to have some negative impacts. But a lot of it is because positioning is overextended. Investors naturally, behaviorally, start with things that have realized gains when they're trying to reduce risk from their portfolio, and so that has a disproportionate impact on the way that certain prices move. So I think we've seen some kind of slightly strange price action, but I think a lot of that has been propelled by positioning and sentiment. We kind of can't ignore the fact that we've had quite a skewed market environment for the past, I don't know how long, at least 3 or 4 months now. Um, I think zooming out a little bit more on geopolitics generally, I think the bigger danger, particularly for long-term investors, when you look at the history, is this idea of reckless prudence, where you're always looking for a reason to sell. There's always a reason not to be invested. But actually, in most cases, you're getting the return because you're taking the risk, and you need to have that consistent exposure over time. And if you look back at the kind of worst sort of decades for equity markets over time, some of them have been associated with major conflict, but we're talking, World War One, World War Two. But a lot of them have been nothing to do with geopolitics. They've been other market developments. So you think about the financial crisis, you think about the dot-com, you think about 1929. And so I think there's generally a tendency to get sucked in sometimes to the media narrative around some of these kind of shocks. But if you look through history for long-term investors, generally, you've wanted to have a portfolio that was diversified and robust and had exposure to different areas of the market. So you're not dependent on one single area. Obviously, if you were very exposed to a particular area in the current market, you'd be struggling. But having that consistency of exposure over time really has been the key. Even if you bought at particularly bad moments in history, when you've seen major shocks, you've tended to find over the next 5 to 10 years that you still generated reasonable expected returns. So I think the short term is very uncertain, risk premium increase, obviously. But I think for most long-term investors, your best bet is to kind of stay the course and keep that diversified asset allocation.
And that's a perfect segue into a historical look back, which is a natural thing to do when we think we're in the throes of a sell-off. And as you mentioned, geopolitics is often in a short-lived sell-off. Just to put things into context, there has been a lot of kind of like pearl clutching as we've seen some of the selling off in markets where the S&P is still flat on the year. And to compare just to previous crises, if we look at the world index, and this goes right back to World War One, not exactly comparable market conditions, but we can see that a real financial crisis can lead to a 60% downside in terms of equity markets. So we really haven't even scratched the surface. There may be the recency bias in terms of the recent strength, but that hasn't been really coming to the fore. I do think it's interesting, though, to think about some of the other factors that may have been driving the current concern. Just to kind of unpack some of the safety trade rotations we were discussing there, we've seen treasuries and gold lose money in the aftermath of the Iran news. So a question, I suppose, what reason gold may have been, what role it was performing in a portfolio here. It doesn't seem to have been used as a flight to safety, but perhaps gold has been behaving unusually, as you mentioned, due to some of the retail components in there. It has been quite volatile at the end of the year. Maybe it's not simply a safety trade. Maybe there was speculative interest in there. And then dollar, having seen this kind of America being one of the safety trades, maybe perceived as that, the dollar strengthening after testing its declining trend after declining for some time. How do you think about dollar weakness or strength, that given you work with a number of pension funds as clients who would have had, perhaps given their global exposure, reasonably strong exposure to the dollar? Do you think that this the dollar strength weakness, does that factor into asset allocation, or should it?
I think the starting point, if you're a UK pension scheme in particular, you have a kind of advantage in that there's a counter-cyclical nature to owning dollars, because you tend to find that in difficult times, particularly market shocks, sterling tends to depreciate and the dollar tends to appreciate. So typically having some dollar exposure for non-US investors is a positive in risk assets, because there's a kind of offsetting correlation impact. I think the dollar story is interesting. Again, it's an area where there's been a lot of sentiment. If we roll back a couple of years, going into the start of last year, it was the consensus trade was to be long dollar. When I worked at Legal in General, just before, the start of 2025, we went through all of the year ahead outlooks, and every single one had long dollar as the consensus trade, and that's a red flag straight away, right? Because if you've got such strong consensus, then the potential for a downside shock is huge. You then had Liberation Day, and a significant weakness since then. We've seen a bit more stability, stuff started to settle. However, I think there's a short-term, long-term issue here. I think short-term, the US is clearly in the ascendancy in this particular conflict. I think people feel they're less exposed to energy because they are energy independent. And so I think there's some natural kind of flight to safety. But I think medium term, we're not going to abandon the dollar. The dollar is too important to the financial system. There's no liquidity and depth that of a comparable market that's going to make it. There's no viable alternative essentially. But what I think you may see is just an incremental rebalancing, and some of these things take a long time. I come from a pension background. If we want to make a change to a regional, a major regional change, that's going to take quarters. There's going to be committees, there's going to be papers, there's going to be independent challenge. And so I think what you'll probably see from a lot of asset owners over time is a question of, do I need 75% of my assets in dollars? Maybe just like 65 is fine. And that doesn't sound like a lot, but the incremental impact of that sort of small reallocation, I think, will be pretty material over time. And that's a kind of longer term structural story. So I think short term, I think it's perfectly reasonable. And I think it's probably one of the risk off trades that has worked mostly consistent with the playbook that you'd expect when when you compare it to, for example, gold and treasuries. But I do think medium term, there are some kind of structural considerations around kind of the non-US investors' exposure to US and the extent to which people feel comfortable with that. I still think there's probably more pressure from that side.
Well, we'll just move on to some of the other factors in equity markets. You mentioned the US being in the ascendancy in the current conflict. I think if we think about AI as an arms race, certainly US is in the ascendancy when it comes to AI readiness and an AI build. And this gets to some of we talked about the building concern in the past few months regarding AI and regarding its outcomes. We talked about the Citrini article. You yourself had a LinkedIn post about reading it twice. And then there have been rebuttals to the Citrini article, its dystopian future that it painted. And it seems that we are right now thinking about AI really with a massive divergence of outcomes, with tremendous uncertainty attached to that. Even since that Citrini article, we did have the Anthropic and Department of War conflict, the kind of basically the specter that even the AI companies themselves perhaps did not trust their own functionality with some absolutely critical functions. So, and we've also seen that the job cuts that we mentioned here, and the inevitability that there will be this mastery of abundant intelligence, but by fewer humans in the loop there. So, how are you thinking about this? Because so much of the equity exposure in any portfolio right now is going to, if it's index based, is going to be levered to the AI and tech story. Do you think we need to think about the risk reward differently, and how can we possibly model such divergent outcomes like this chart here, which shows that really we could be looking at the Citrini reality or some very beneficial and hyper productive reality?
Yeah, I mean that chart is one of my favorite charts, all-time charts, because it's hilarious, but it kind of actually shows you the reality of the situation. And the reality of the situation is your confidence bands need to be so wide because no one really has a strong idea of how this is going to progress. It's progressing so quickly that it's very difficult to know. And as you know, the Citrini article has been very much in the back of my mind now for a few weeks. I keep thinking about it when I'm kind of eating my breakfast or in the shower or something. It just kind of pops into my head. I think in general, I think there's probably a short-term over appreciation of the disruption and a longer-term under appreciation of the disruption. That's kind of the way I'm thinking about it at the moment. So if you think about the labor market, for example, I don't think we're going to hit 10% unemployment next year. I could look stupid by when we get there, but I'm pretty confident that a lot of this is going to take more time to flow through. You know what it's like. The average white collar job is a series of tasks. And a lot of those tasks can be improved or complemented by automation, but it's very difficult to end replace the entire workflow overnight. That will happen in some areas for sure. For example, there's huge developments being made in software engineering, customer services, that kind of stuff. But I think the idea that the average office worker within a year is totally redundant is a little bit far-fetched. In the same way that I think the so-called SaaS apocalypse, which has been a real issue for some of our active equity portfolios, these types of companies, they pop up everywhere. They're in growth mandates, they're in quality mandates because they're so attractive. They have recurring revenue, they are not levered, they have consistent growth, great pricing power. So they're the active manager's dream. And so they've been, you've seen really terrible performance the first quarter this year when you've seen the weakness in those stocks. But much like when we're talking about the labor market, is a company going to rip out their cybersecurity system overnight for something that's been vibe coded using Claude? Probably not. That said, I think should those companies continue to trade at 30 times EBITDA? Perhaps not. There probably needs to be a little bit of a risk premium embedded there. So I think there's been a little bit of a kind of gap in the market, a difficulty with finding an equilibrium because no one really knows exactly where we're going to end up here. But I think some kind of AI risk premium in those types of exposed sectors makes sense. But in some cases, the idea that this is existential within 12 months is probably overplayed. But when we roll forward medium term, I think people are, particularly the broader public, we are very engaged with this type of stuff because we spend all day reading research articles about it. But the average person is a long way removed from this. And I do think there's a complacency perhaps about the extent to which this might transform the economy in the next 5 to 10 years. I was thinking about an example the other day of media, the media industry. If you can have AI generated films, TV shows, podcasts, I know we're on a podcast right now, or music, and the AI can generate 1,000 of those a day, and they can do that for 100 days in a row. We're in a very different landscape in terms of IP, in terms of the extent to which things can be commoditized, and that's just one example. So there's a huge amount of extrapolation that doesn't need to go full science fiction for us to get kind of profound consequences for certain industries. So yeah, to summarize quite a long answer there, but I think short term, a lot of this is a reflection of the market just really struggling to find a coherent narrative, and so they're just going for maximum risk premium. Let's just worry about this later on. Just get the discounts in, or move to a different sector. Buy some halo stocks, as people are calling them. But I think medium term, there are some more profound consequences, economically in particular, that will need to be kind of reckoned with.
And we've also had that concept of selling first and asking questions later, or seeing later whether that outcome is really the case. And just to finish on the positive outcome, a couple of stats just came out this week about in terms of the explosion in coding productivity. As you mentioned, the average person is probably not coding for a living, but just in terms of just the major impact that's had on that. And then just we talked about grid tech and the picks and shovels of AI and how that's also the need for energy, a good place for portfolios to be diversified, given that that does seem to be persistent. We've now been talking about space and the space infrastructure investment cycle. So if we're talking about the scheme of science fiction and being and kind of really having long-term time horizons, that the space investment thesis seems to be to be an emerging one. So just moving on to other asset classes because we've a lot to cover and to bring this to the close here. Private credit, I know as head of external manager research, you are focused on many external managers, and private credit has had another bleak week in terms of sell-offs. We've seen these sell-offs move through some of the marquee names in private credit. A lot of it related to that SaaS apocalypse you mentioned before, a concern about contamination, a concern about the moving in of some of these asset classes for the private wealth investor, for my world, which it's not as much touching the pension fund world. How are you thinking about the private credit and I suppose the private equity outlook here as well? And we can really talk about those both together. They are intertwined. Getting less focused this week, perhaps private equity, but we do know at the backdrop there have been a slowing of exits, a slowing of cash distributions, a lot of cash on the sidelines, which may well be driving some of this equity market strength, even because we know there is pent-up demand. So any thoughts on the current private credit headlines that we've seen this week and the backdrop for private equity too?
Yeah, I mean, I used to manage a portfolio that had a large allocation to the BDCs, which are listed private credit vehicles, so I know them quite well. I think there's a lot of hysteria. I don't think that's been helped by, for example, Jamie Dimon's comments. But I think if you actually pick through for the high quality GPs, I was asking one of our private credit research analysts about this yesterday. They've seen this coming for a while. The SaaS news, the AI disruption is not new from their perspective. And so when you look at the higher quality portfolios in direct lending, I think generally they are holding up relatively well. I think what you're seeing in the listed vehicles is a combination of some risk premium, like we talked about before, the kind of ask questions later, sell first, ask questions later. There's a little bit of that. But I think when you look on the unlisted side, which is where we see a lot of our exposure, generally there's been we've got a lot more comfort. You're seeing the fundamentals of those companies seem a lot more secure. That said, medium term, again, there's still probably a sensible risk premium to be applied from the fact that we really don't know the outcome from the AI development over the next sort of 5 years or so. So what we try to do is have diversification, which I think is, it's a kind of boring answer, but I think it's the important one. So let's have different types of direct lending. Let's focus on different parts of the market. For example, in Europe, there's a lot less exposure to these types of companies. We'll have opportunistic credit, and actually they can be on the other side of some of this. For example, when some of these names start to become really distressed, that can be an opportunity if you can work it out effectively, or things like asset-backed lending. And, we've seen problems there as well. But I think for the good quality, high-end GPs, generally, they've held up pretty well. I think what we need to remember about private credit, this is a sub-investment grade asset class. This is not treasuries. So we shouldn't be flattered by the last 10 years of really low defaults. This type of area, high yield loans, direct lending, you are going to get defaults. Even the best managers are going to have them. But the whole point is you're getting an expected return prior to defaults that is significantly higher than any other bond market. So net, you probably still work out, even in a difficult default environment, with a solid long-term return as a long-term investor. And so I think people keeping that in mind and not getting too hysterical about, small changes to carrying values for some of these loans, I think is a good starting point, but it's definitely a real risk. I think if you've got a very concentrated portfolio that is very exposed, so some of the single BDCs, for example, have got a lot of exposure to kind of SME tech, I think, yeah, fine. I think there's a perfectly reasonable risk premium to be built into that space. But I think at the bigger end, particularly the higher quality names with a lot more diversification, generally, I think you're still going to come out of this with a pretty solid net return. If we think about private equity, your points are correct. I think the issue there has been the difficulty. There's a bit of a logjam when it comes to capital flowing through that space, and that's not going to be helped by the current market turbulence that we've seen. We were just getting to a point where it felt like the IPO pipeline was going to start again. I think there were some pretty big IPOs cited for this year. If those don't get away, then that's going to continue to back things up. Last year, optically, was a pretty good year for exits, but it was dominated by a pretty small number of deals. I think actually, if you looked at the median deal, there's still some problems there. That said, we see some opportunities. In this kind of space, when you've got that kind of traffic jam of liquidity, things like secondaries start to become a little bit more interesting. You might find that there's opportunities to take things off the books at a discount because people need liquidity. And so for long-term investors like us, that's interesting. And if you look at the managers, I mean, the share prices of the managers have been really hit hard if you look at, Blackstone and the like. And I think again, like we've talked about before, perhaps it's reasonable to have a little bit of risk premium built in, but at the same time, I don't think someone's going to build an AI automated version of Blackstone within the next 1 or 2 years. So we need to have a little bit of a kind of a medium term consideration there. So I think those stocks have generally shown an incredible ability to monetize this rise in private markets. I don't think the rise in private markets is going away. Yes, we need to see a little bit more liquidity returning to the market, but at the same time, I've got very few concerns about the health of the broader private market sector. Individual actors, there could be some weakness, particularly those who are really skewed into a particular area that's exposed. But generally, I'm trying to be a little bit more measured about it, and I think medium term it still has a pretty important place in most institutional investment portfolios.
Exactly. And the old adage about following the money, it seems that the insiders here are perhaps doubling down, or they're reinvesting in their own assets. There has been, I think, an internal buy-in from some companies by their employees to allow for redemptions in the funds. We've also seen vulture investors snap up some of the closed-end funds that are trading at a discount. And I suppose we should never underestimate the effect of incentives when it comes to the skin in the game that private equity and private credit managers so often display. Well, thank you so much, Ryan. That has been a whistle-stop tour of the world of asset allocation, as well as literally the global world of geopolitics. So thank you so much for sharing your insights with us. For our listeners, and this is the first of 2 podcasts today. The second podcast will be recorded today in New York City live. It's going to be a special deep dive into AI and investing. So we won't be repeating these themes unless we have something else to say in the next 5 hours. So thank you, Ryan. Thank you very much for joining us here.
Thanks.